Potential sale of PacWest Bank. It introduces a new stress point in the banking sector. This presents another risk for the Fed to consider after delivering an additional rate hike yesterday for the 10th straight meeting. For the first time since 2007, rates now sit above 5%. Meanwhile, the question of what comes next, that still lingers. Fed Chair Powell's remarks yesterday leaned on two words, offering some clues as to what investors should take away from the Fed's thinking. Meaningful and restrictive, those two words. Take a listen.
We're saying that in determining the extent to which additional policy firming may be appropriate to return inflation at 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. With our monetary policy, we're trying to reach and then stay at for an extended period a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time.
But with added banking stresses and several economic unknowns, where does this leave the markets? Here to discuss, we've got Hugh Roberts, who is the Quant Insight head of analytics. Hugh, great to have you here with us this morning. So perhaps we start there with that very question here, and largely what this means for the banks as well that have essentially been extremely reactive to the Fed's policy as well as some of their own decision making on the management levels.
Yeah, so we would give a very different perspective to your previous guest. It was fascinating listening to David, who's obviously clearly in at the very single stock level. What we have is a smart machine, an AI-driven machine that just basically looks at everything through a macro lens. So when we look at everything versus growth, versus inflation, credit conditions, risk appetite, all that kind of stuff. And if you look at KRE, for example, at the moment, to get an aggregate picture of regional banks, then macro momentum is still pointing south. There's no immediate respite for the regional banks coming from the macro picture, at least. So on that front there's no real kind of immediate opportunity. I think more broadly from our side is we're kind of a little bit like Chairman Powell yesterday. I mean, watching the press conference, I got the impression he kind of gave a hospital pass. The issue now of the regional banks is really one for the regulator, rather than for the Federal Reserve and for monetary policy or financial stability. And now we're kind of looking at that big picture stuff as well, rather than the kind of minutiae of individual names.
And Powell did note the senior loan officer survey SLOOS. That's going to show that the tightening is continuing in the banking for some of these smaller banks, and that's tightening considerably. How much does this then bring forward the timeline of when we could see a pivot if these tighter lending conditions essentially act as another hike?
Yeah, I think that's exactly right. I mean, the minutes of the March meeting that came out a week or so back confirmed that the Fed now acknowledged that the kind of the credit crunch that we're seeing at the moment work in the same direction as rate hikes. So we're kind of getting a double whammy, if you like. So I think that's a very fair question in terms of does this kind of expedite things? Again, to reiterate, we don't really have forecasts per se. We don't forecast is a recession going to hit in Q2 versus Q3 or even Q4. What we do really is measure the relationship between any individual asset and the broad macro environment. That's what our AI machine does. So my answer to that question would be more along the lines of we can look, say, across sectors and say, right, which of the US equity sectors are most vulnerable should US high yield credit spreads start to widen? And the answer to that question would be actually it's the property sector. It's stuff like XHB, the home builders. It's stuff like home construction. They are the sectors that screen as the ones that would be most vulnerable if credit spreads start to widen because of the credit crunch starts to really hit up. And if we get evidence of that, as you say, from the Fed Senior Loan Officer survey next week.
Based on the Fed's policy pathway as of right now, many of the bank CEOs had come out early in earnings season and said that they're looking for a recession to come in Q3 of 2023. From what you're seeing from an economic perspective, from what you've heard from Fed Chair Powell's commentary yesterday, and even the glimpse of what they may do from here, what does that spell out to you? Are we looking at Q3 2023, or from a quant perspective, is there something else at play?
Yeah, I mean, I personally, my kind of non-QI answer would be that, yeah, all the ingredients for a recession are clearly there. In fact, just in the last week, look at the message coming from the bond market, look at how commodities are trading. It still feels very much like the recession will come. It's just that the leads and lags have been thrown out. I mean, everything goes back to COVID and lockdowns, and it's just been an incredibly difficult cycle to time this time around. So I think it's still a question of when rather than if would be my personal answer. So really what we then do is use the machine to try and find the assets that are trading rich to macro conditions, therefore kind of lag to potential recession and therefore offer a good entry point. And those two kind of home builders, home construction ETFs would be examples of that. Or we look for assets that have actually kind of overrun things and have sold off too much in advance. So again, sorry to duck the question. It's not that, it's just that we don't really predict or forecast. We don't have a call on the US economy or whether the ECB continue hiking for another 50 basis points or not. What we capture is the relationship between all these assets, single stocks, currency crosses, etc., and the broad macro environment.
So as you look at some of the sectors then that have already sort of priced in, I guess, the best case scenario, which ones are the standouts for you?
There aren't many, I'm afraid, at the moment. If you're looking to buy the dip, then the best we can get really is stuff that's actually trading close to model value and where model value isn't falling, model value capturing the entire macro complex. Something like metals and mining, XME, clearly is a cyclical player in most people's eyes. So obviously the commodity story will have an influence. But if you look on our machine, then it's bang in line with model value, and model value is moving sideways rather than declining. So that would be a kind of cautious long from our side. But at the moment, the skew is very much towards assets that really are trading rich. That would include technology. The trouble with technology is they're not macro plays at the moment. One of the things that the machine spits out is a model confidence number. So that enables you to say, well, this particular security is trading off a macro dynamic, or it's trading off company fundamentals, is more idiosyncratic. And although we have XLK, we have XLC, all this stuff as a little bit rich at the moment, they all have low model confidence. They're driving off generative AI as a story rather than anything else, anything macro.
I do appreciate you breaking all that down for us. A big thank you to Hugh Roberts, Quant Insight Head of Analytics. Thank you for your time this morning.